Hello and welcome to this FinGraph podcast on Dukascopy TV. Today we're going to review the cross-asset outlook after this first week of October and consider what could happen over the next couple of months. To do so, we will look at our fingraphs.com platform and first to a mosaic of different instruments over two frequencies. So we do have the mini S&P future here, the Euro-US dollar, the US 10-year Treasury note, so the inverse to yields, as well as gold. And this is a daily basis for the perspective over the next few months. And below here, on the lower line, we have the hourly graphs for the perspective over the next few weeks. What we could say is that at the moment, the mini S&P future, the Euro-US dollar, and gold have been in similar dynamics since March. They are trending up for the first two and are in an intermediate correction for gold. Treasury notes have been moving higher, but very marginally over the last few months, given that interest rates have fallen to very low levels already. They are currently in an intermediate correction, but we do believe the uptrend is still in place. Shorter term, following the September sell-off, we can see that the mini S&P future is attempting to react to the upside. Same situation for Euro-US dollar. We've seen some correction on the Treasury note, and gold is also attempting to resume higher. We're going to look at these on an individual basis, and first as the S&P 500. The S&P 500, in our view, is still in an uptrend. It is in an exaggeration at the moment on our envelopes, but it's not quite overbought yet again on our risk indicator. We do believe that the period between 2018 and March 2020 was a widening triangle and probably a consolidation pattern, and that we may have started a very strong and long-lasting new leg up on a nominal terms at least. In terms of targets, we could still make it back up to 2,600, 2,700, perhaps above, but we would consider these targets towards next spring. And at the moment, the exaggeration that we see should extend the current consolidation that we've seen over the next month or so for another few weeks at least. So let's look now at the daily graph, which saw this top early September and a correction. For now, the move hasn't been strong enough to create a counter trend, so we are still theoretically in an uptrend that is resuming higher. Yet our oscillators and the risk index here is quite overbought and close to the red zone here. So we would expect that the current counter trend move, which started in September, probably extends into early mid-November. In the meantime, we've seen a first leg down, believe that we are in a reaction up, maybe a retest up, and then following that, from late October, we would expect a further downside retest, which may make marginal new lows to the one we've seen late September. So on the hourly, this gives us a support point late September, a rally which has since been developing. It may last another week, maybe 10 days, lead us back up to above 3,550, maybe perhaps towards the September highs. But from the third week, fourth week of October, we expect a new retest down to the lows around 3,200 that we saw 2 weeks ago. Then we're still in an uptrend, so from mid-November, we expect the S&P 500 to gradually resume its uptrend towards year end and then towards next spring. Looking at the euro dollar, we believe we see a similar situation. We were in a correction between 2018 and 2020. When the S&P 500 was in a widening triangle. So also a consolidation pattern here, but just one which was much weaker. And since March, we've seen a very strong rally of the euro. We believe this rally is or could be the beginning of a longer-term uptrend, and that we are currently within or have just finished a first leg up. Why do we think that we may be within? Is that we've seen an intermediate top in August, some correction into late September, and at the moment there is a potential bounce, which could still lead us back up towards 119, maybe 120, and perhaps to marginal new highs over the next couple of weeks. Thereafter, also, we would expect further consolidation or further retracement into early mid-November, towards the election and in the direct aftermath of the election. And we do think that the euro-US dollar could then retest down towards 116 that we've pretty much seen, and perhaps marginally below towards 115. From mid-November, we then expect the euro-US dollar to gradually resume its uptrend into December, towards year end, and then possibly towards next spring, and potentially up to the tops that were in place in 2018, so up to 124, 125. In the meantime, short term, we could see that we are in a bounce. It is getting close to the resistance, short-term resistance of our corrective targets to the upside around 118.35. If we do make it above these levels, the potential is up towards 119, 120 over the next week or so. Thereafter, again, we expect further retracement into early mid-November before the trend resumes higher into year-end and next year. On Treasury notes, we can see the very, very strong rally which has been materializing since the Fed started to U-turn at the end of 2018, and then a massive acceleration as the Fed cut 150 basis points in March. We believe this trend is not over yet and could extend into spring next year at least. So we're still, we believe, in a downtrend on interest rates in the US. At the moment, we're a bit overbought on our oscillators as well as on our envelopes. And so naturally, we are seeing an intermediate correction, which we could monitor here on the daily. And we could have a bit more to go over the next few weeks. Possibly into late October and towards the 137, 135 range, which would bring us back pretty much towards the June lows or the June retracement, and eventually, but that seems a bit far out, towards the March correction here. So on rates, we are in an intermediate correction. It's probably not over yet, probably has a bit more to go, but we don't believe it will be long-lasting. The month of November, we should see a resume of trend situation into next spring, and possibly with higher highs on the Treasury note, so lower lows on Treasury yields. Shorter term, the current move down is quite oversold here on our oscillators, but doesn't seem quite finished on our trend and target indicators. So we would expect a bit of a bounce here and then a further downside into late November. We would see marginal new lows, but probably not as deep as expected here on the daily. Finally, we look at gold. We're still bullish on gold. It had a fantastic acceleration here, which we had projected quite well. It is exaggerated here on our envelopes, but still below the overbought zone on a long-term basis on our risk index. We do expect it to continue higher into next spring, possibly as interest rates remain quite low and subdued. Our targets here are showing our impulsive up targets to the upside, which have been achieved, but we can calculate extended targets, impulsive 2 targets, which do lead us up potentially up to 2,300 towards next spring. In the meantime, we are in an intermediate correction, which may last another few weeks. The support around 1,800 has held very well into late September, and we believe it will continue to hold. We then expect that from early mid-November, gold gradually resumes its uptrend, possibly into December, then towards year end, and then next spring. Shorter term, we are in the premises of a bounce. If we do make it above 1931, which is our short-term resistance, we may then see a rally up to the higher 1900s over the next week or so, and then a further retracement into early mid-November before the secular trend actually resumes higher into next spring. Thank you very much for your attention, and we wish you a very good week of trading.